Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The stock sell-off takes a breather after another jump in Treasury yields. Fed Chair Jerome Powell reversing course, saying rates can be kept steady as long as needed. Morgan Stanley is said to plan its biggest round of job cuts in China in years. We bring you our scoop and a wrap of Wall Street bank earnings. Plus, the corporate earnings focus shifts to Europe with two heavy hitters reporting. Luxury giant LVMH reveals a slowdown in sales and now dropping across the terminal. The details coming through from ASML, the chip equipment supplier, of course. Bookings for the first quarter, a miss for ASML, coming in at 3.61 billion euros. The estimates had been for 4.63 billion euros. So a sizable miss in terms of first quarter bookings. We know the analysts have been scrutinising that data point out of these first quarter numbers. The focus as well on the demand out of China, given the US restrictions, and we'll look for details on that. Second quarter gross margin, the forecast from ASML is that it'll get 50 to 51% in terms of the gross margin for the second quarter. Looking ahead to the second quarter as well, they see sales of between 5.7 billion euros to 6.2 billion euros. The previous estimate had been for 6.46 billion euros. So that's looking ahead to the second quarter. But again, coming back to the first quarter numbers, sales and the orders missing the estimates. On the sales numbers, net sales 5.29 billion euros. The estimates have been for 5.47 billion euros. But again, the top line, the redhead across the terminal, first quarter bookings for ASML, which of course provides the essential equipment to making the high-end semiconductors used in everything from EVs to missile systems. Those first quarter bookings coming in significantly below the estimates, 3.61 billion euros versus 4.63 billion. So we'll be checking that at the open, of course, for you, and the read across to the European semiconductor space. Let's check in on these markets. As we say, stocks taking a bit of a breather given the sell-off that we've seen. 3 straight days of selling pressure that's come across US stocks. Today, though, futures pointing slightly higher. Yields, yes, jumped again yesterday. In fact, the front end saw yields moving at the 2-year to a little above 5%. We'll get into the detail of that in the next minute or so. But the futures, when it comes to European futures, are looking a little brighter, up 0.1% after the sell-off that we saw yesterday. Modest sell-off in European stocks. FTSE 100 futures pointing higher by 0.3%. S&P futures stateside looking back above 5,100 to gain a little under 0.2%. Nasdaq futures also pointing higher, again, modestly by 0.2%. Let's flip the board cross-asset then and reflect on the moves that we've seen. Again, the sell-off across treasuries, the 2-year did break through that 5% level, now at 4.97%. Not a lot of movement in the treasury story today, but of course you have seen that run up in yields. J. Powell seemingly reversing course from the comments he made in March, painting a picture of higher for longer when it comes to these rates. 124 on the pound as we look ahead to the CPI, the inflation print out of the UK, 7 a.m. UK time, expected to moderate from 3.4% to 3.1%. The pound currently at 124. Brent, $89 a barrel, down 0.5% as investors in the oil space continue to wait for that potential Israeli response to Iran. And iron ore prices actually rallying in the sessions today, so a turnaround from the picture yesterday. We're going to be watching miners then, listed in the UK at the open, 112 on iron ore per tonne, up 2.6%. Let's cross over to Asia, where mainland markets in China are having a relatively positive session. Avril Hong is standing by in Singapore. Avril.
Yeah, Tom, we're seeing Asia stocks catching a bit of a breather, similar to what we're seeing in the other parts of the world. And the currency is where the focus is really at, as they've gotten hammered in the past week or so, no thanks to the US inflation print. And despite the hawkish comments from Powell lamenting the lack of progress on inflation, the idea here behind their rebound seems to be that he's not saying something materially different. Traders were already pricing in a delay in those rate cuts. So we're seeing the Korean won, the Japanese yen, they're recovering some lost ground. That being said, the won's still hovering near the 1400 level that it hit yesterday. The yen, some say 160 could be next. On the Chinese currency, 730 seems to be the next level to watch. We did get the PBOC yuan fix coming in at 710 for another session. So that seems to suggest that a new trading range is in play. But let's flip the board and take a closer look at what we're seeing on the Japanese yen as well as the Korean won, as we got jawboning from South Korean finance ministry officials. They're said to have met the Japanese counterparts. They're said to have discussed their serious concerns about the weakness in their local currencies as well as the volatility. So the jawboning for now also seems to be helping somewhat. Let's take another look also at what we're seeing in the stocks, because as you saw earlier, the gauge of stocks in the region is pretty flat. This is stemming the losses that we've seen in the past week or so. And thanks to the Chinese stocks rebound, as you mentioned, Tom, that is helping to offset the declines we're seeing in Japan. And part of why we're seeing Chinese stocks run higher today is the top securities regulator coming in to ease some of the concerns about potential delisting of companies with weak financial health. So we're seeing the small cap gauge surging today, Tom.
Ava Hong in Singapore with the breakdown of the Asian markets. Welcome back, and thank you very much indeed. To Jay Powell now, where the Fed Chair has signalled that the Federal Reserve will wait longer than previously anticipated to cut interest rates in the wake of course, a series of higher than expected inflation readings.
Greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's bring in Bloomberg's executive editor for Asia markets then, Paul Dobson. Paul, it seems like a marked change of tone from Fed Chair Jay Powell from just March, when he said he was getting more confident, at least getting a little bit more confident that they could be closer to cutting. A reverse mark of tone, it seems, a marked reversal of tone, I should say, from the Fed Chair. Talk to us about the market reaction to what we've been hearing from Jay Powell.
Yeah, so you might wonder whether the market reaction would have been a little bit more violent in the U.S. session. Yes, we did see higher bond yields. We did see a little bit of weakness in equities as well, but nothing too profound considering that, this is the Fed chair shifting slightly his view. But I think that because so many of the Fed policymakers have already put that same idea out there, it's not really a surprise to see him relent eventually. And as well, the market had already moved to price in pretty much the scenario that he's talking about, where maybe the first hike doesn't come till September or even November, looking at what the market is now factoring in. However, there's two ways of looking at it, because as well as the, relative calm in the US markets, a lot has moved over the past 10 days. We've got those much higher Treasury yields, highest for the year to date. And it's really the rest of the world that is bearing the brunt of this in some ways, as Ava was talking about with the FX markets in Asia, really under pressure in recent days from the strength of the dollar. It's a kind of our currency, your problem scenario once again.
Yeah, the hammer blow of the strong US dollar really being felt across the FX markets, particularly in Asia yesterday. How is the FX space holding up today then, Paul?
So, holding up better with quite a lot of nerves out there. I did think that it was significant, this comment from South Korea, that they've been talking with Japan and voicing their concerns together. I think that's really interesting, and I think we're going to want to pay attention to what's happening at the G20 meeting in Washington this week and whether FX does force itself onto the agenda, given the volatility and the moves that we've seen of late and just the pressure that Asia's central banks are under. The market is moving to start to think about, will some of the central banks here have to even hike interest rates in order to contain their currencies and give them that extra support? Where are the weak spots in the market? We're starting to see some probing and some pressures as well as we blast through a lot of those key levels right across the entire FX complex here. So the pressure is starting to mount, even if today maybe not as violent as what we've seen in recent sessions.
OK, maybe just a temporary reprieve then for some of these currencies. Bloomberg's executive editor for Asia markets with a breakdown for us. Paul Dobson, thank you very much. Now, Bloomberg has learned that Morgan Stanley plans to cut about 50 investment banking jobs in the APAC region starting this week. At least 80% of the reductions are likely to be in Hong Kong and mainland China. Let's get more then from our Bloomberg finance reporter on this Bloomberg scoop, Adam Hay. Adam, what do we know then about the job cuts and what it tells us more broadly about China's ongoing struggles?
Well, at the moment, Tom, what we do know is that we expect that 50 roles will go, as you said, in the investment banking, across the investment banking department. But this will be a major focus on Hong Kong and China, as you say, 80% of the cuts coming from those two locations. And clearly, this is a sign that Morgan Stanley still has more adjustments to be made in the Asia-Pacific region as it kind of reallocates some of its resources, given what's happening in China. The very well-flagged and well-understood story of the slowdown in China and the decrease in the deal activity that we've seen there. The sluggish nature of the IPO market there on the equity side, but also the debt market there that's been struggling as well. So clearly, this is another sign of them needing to bring back some of the resources there, to cut costs in certain areas there. But we've seen it, of course, at some other peers in the region, and specifically with very China-focused, China-related jobs that they've had to pare back. And of course, globally, a lot of the US investment banks continue to cut back jobs in certain areas. The businesses continue to be kind of hammered from a number of different directions. But of course, we have seen in these latest numbers over the last few days, Tom, that some of these investment banks are seeing increased activity levels, both in equities and in fixed income. You saw in the Bank of America numbers recently just how much of an improvement there've been in that equity flow. Of course, equity markets in Asia Pacific have been buoyant. Certainly, Japan has been a standout market that really has come back onto the landscape for many global investors, having been kind of shunned for many years, and increased activity there has helped. But also on the fixed income side, as we've seen with a lot of readjustment in positions, especially in treasuries, but really across the developed world, mature bond markets, those government bond markets have repriced a scenario that looks quite different for interest rates than it did a few months ago. And of course, that's coincided with increased activity, increased volatility, which is playing through to these revenue lines for some of these banks. So that's the good story, the good news story coming out of some of these investment banks. But of course, you still have this issue that lending income continues to be a pretty big area of pressure there. Net interest income is continuing to be a tricky area for these banks.
OK, Adam Hegg, thank you very much indeed. We'll continue to monitor, of course, whether or not the pickup in trading businesses for some of these banks is going to be sustainable. As we say, and as you unpack the retrenchment out of China that continues, at least mainland China and Hong Kong, at least partial retrenchment. Thank you very much indeed. Right, checking in on what else you need to know today. This is the day ahead picture then. 7 a.m. UK time. It's the data print of the day for the UK. It's inflation data that comes out. The expectation at 7 a.m. is you're going to see a moderation for the March print from 3.4% to 3.1%. in March. Of course, really consequential given the BOE. And we've been hearing from Andrew Bailey suggesting the inflation dynamics are looking more positive here in the UK versus the US, for example. So that data at 7 a.m. UK time. 10 a.m. UK time, we're going to get the finalised Euro area CPI. So a build out of the picture in terms of the inflation trajectory in the Eurozone. And at 7 p.m. UK time, it's the Fed Beige Book. So details of the 12 districts, of course, that the Fed covers and real colour on the US economy. So that's going to be really important as well. 7 p.m. UK time, the Fed Beige Book. Coming up, the US says it will impose new sanctions on Iran in the coming days. We have the details next. Plus, JPMorgan is all in on AI. Don't miss the best of our interview with CEO Jamie Dimon from the circuit with Bloomberg Originals' Emily Chang. That conversation later in the show. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the US says it will impose new sanctions on Iran, targeting the country's missile and drone program. It follows, of course, Tehran's weekend attack on Israel that's threatening to push the Middle East into a wider conflict and, of course, unprecedented attack there from Iran over the weekend. Let's get the details then with Bloomberg's Patrick Sykes, who's been following all of this for us. Patrick, I guess the key question is what significance these sanctions really are. I mean, sanctions have a patchy record at best. Is this merely symbolic from the US, or is there a real deterrence here?
Morning, Tom. Yes, that's right. We know so far they're targeting the drone and missile programs. That's, of course, specifically intended because that was the nature of this weekend attack that you mentioned. We know that EU is also planning similar moves, and I think it's reasonable to expect the UK would be thinking about it as well. But as you say, Iran has a long track record of dealing with sanctions. It's already very heavily sanctioned place. It's built this entire so-called resistance economy based on the idea of finding ways around them and making them work with links to countries like Russia and North Korea, with whom they can continue to develop those arms programs. I think the symbolism is much more important in this case. It's more of a diplomatic signal to Israel. It's saying, we, your allies, we're all here. We're acting immediately in the days after that attack. And therefore, perhaps, you don't need to go so hard in your planned military response to that attack. Take this as a message of support and feel reassured that we're here for your security.
Well, Patrick, on that point then, what more do we know right now about Israel's plans? They've been pretty clear. They say they will respond in some way. Do we have any more clarity?
Yeah, we had a story yesterday sort of outlining some of the potential scenarios. I think the key one, stepping from least to most escalatory, would be something like a cyber attack or an attack on Iran's allies or proxies outside Iran, but in the region. Then you have more of like a missile strike within Iran on perhaps a military facility associated with that missile or drone program that was used over the weekend. And finally, at the very top, some kind of targeting of a nuclear-related facility in Iran, that obviously being the most escalatory. We don't know which way Israel is leaning among all of those. What we do know is that the War Cabinet's planned third meeting yesterday since the attack was postponed. So I think that perhaps just signals that, there is this space for deliberation. They're signaling they're not rushing in to a decision. In terms of security prospects, I think that does at least signal that they're very much open to moderating that response. But I think we can't underestimate the fact that they do feel they need to respond. They do feel they need to regain that deterrence and show some strength domestically as well.
Bloomberg's Patrick Sykes joining us out of Istanbul on the latest in terms of the US sanctions on Iran and the deliberations that continue in Israel and the potential consequences. Thank you very much indeed. Let's check in. The markets, of course, particularly in the oil markets and the oil space, on tenterhooks, on hold at least for that potential response from Israel. Currently, Brent at 89.45 as investors await for that clarity. Down 0.6% so far in the session, of course, back down below $90 a barrel. 84.76 on WTI, down 0.7% in the session. Gold holding above 2,380, of course, as a hedging mechanism for investors. That continues. Just down 0.1% so far in the session, but of course gold has had a storming year-to-date move. 2,380 currently per troy ounce for gold. We continue to watch those assets. More details in terms of the earnings story. You broke ASML at the top of the show. Now it's Volvo Trucks. That business coming in with adjusted operating margin for the first quarter. Adjusted operating margin for the first quarter of 13.8%. That is a beat from the estimates coming through from Volvo. The estimates had been for 13.1%. It's a beat on the first quarter adjusted operating margin. In terms of net sales, also a beat from Volvo. First quarter net sales coming in at 131.2 billion Swedish krona versus 129 billion with the estimate. So it's a beat in terms of the sales, it's a beat in terms of the operating margin. Profit also coming in higher as well for Volvo. So watch that stock at the open, 8 a.m. UK time, of course. Coming up, LVMH's sales growth sputters, weighed down by softening luxury demand from China. ADRs, though, in the US jumped on the back of those earnings. We're going to have the details next. This is Bloomberg. Happy Wednesday. Welcome back to Bloomberg Daybreak Europe. Now, LVMH has reported its weakest first quarter sales growth since 2016. Since 2016, excluding the pandemic, of course, in 2020. The world's biggest luxury group has been hit by weak demand for cognac and champagne. Let's bring in Bloomberg's Caroline Connor in Paris. I wonder if we can blame Caroline for some of this. Caroline, is LVMH then also feeling the squeeze? We've seen this, of course, from other luxury groups, Kering, particularly feeling the squeeze when it comes to that demand out of China. To what extent is the China story playing into LVMH, or is it a bigger picture story when it comes to this luxury conglomerate?
There's been, of course, a lot of anxiety after this profit warning from Kering, the owner of Gucci, last month, especially, as you mentioned, about the exposure in China and in the US, which is not totally recovering for the luxury sector. And if you look at the fashion and leather division for LVMH, which is the most important because it includes their label, Louis Vuitton, also Christian Dior and Celine, the organic sales in the first quarter are up just 2%. As you mentioned, that's the weakest quarter since 2016 if you exclude the pandemic. Of course, very tough comparison in the first quarter of last year where sales were up 18%. Chinese demand still not totally recovering. And even though Chinese demand for this specific division is actually up 10%, if you consider also Chinese travelers abroad, LVMH overall sales in Asia, excluding Japan, are down 6% in the quarter. And meanwhile, the US is not totally recovering. We're not seeing this recovery story quite yet for LVMH. It's impacting also the wines and spirits division. That includes Dom Pérignon Champagne, Moet, and Cognac. Cognac makers impacted on one side by US retailers being much more cautious about cognac in their stores, and also this probe into makers of cognac in China. So the wines and spirits division suffering also in the first quarter with organic sales down 12%. One bright spot for LVMH in this first quarter was selective retail with Sephora, and organic sales there up 11%, but the jewelry with Tiffany Bulgari also suffering down 2%. Overall, LVMH saying they remain both vigilant and confident for the rest of this year.
Caroline, what is the broader read across then from this LVMH earnings story for the rest of the luxury sector?
Kering, of course, was a very specific story because they suffer from also a designer transition at Gucci. But clearly, LVMH is more resilient usually. They have 75 brands. They have a more diverse portfolio. So usually they can spread across the difficulties they may find in some markets. But the aspirational consumer is still not back. The Chinese consumer is more picky. The Chinese consumer spends less but buys better. This has brought, for example, one Citi analyst to say that eventually, potentially, Hermes could actually surpass Louis Vuitton in China. The reaction from analysts about this LVMH release last night was quite muted. If you see one analyst from Jefferies talking about it's fine in absolute, still unclear on relative. This other analyst from Citi talks about sales in line with very low bar expectations in still a subdued demand environment. We'll see how this goes for the second half of the year, and
Caroline,
we'll get Hermes next week.
Caroline Connor, thank you very much indeed with the LVMH earnings. Coming up, ASML reports worse than expected bookings for the first quarter. We're going to get the details next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The stock sell-off takes a breather after another jump in Treasury yields. Fed Chair Jerome Powell reversing course, saying rates can be kept steady as long as needed. Bank of Governor Andrew Bailey hints the central bank may be able to cut rates before the Fed, saying inflation dynamics in the two countries are diverging. Plus, new orders at ASML fall short of estimates in the latest quarter as demand for advanced chip machines slows. Let's check in on these markets. We look ahead, of course, to the open at 8 o'clock, and we'll be watching the tech sector here in Europe on the back of those disappointing numbers coming through from ASML. But European futures still holding in positive territory after the modest losses of yesterday. Gains of 0.2% being flagged across the Stocks 50 futures. Here in the UK, FTSE 100 futures pointing higher by 0.3%. We're watching the miners on higher iron ore prices. S&P futures stateside looking to gains of 0.2% after 3 straight days of losses. And again, we talk about the run-up in yields and Jay Powell's marked change of tone as well yesterday in those comments. Nasdaq futures pointing to gains of 31 points. Let's flip the board then and look at the 2-year, where you saw a jump yesterday above 5%, moderated a little bit. Treasuries taking a breather, as is the dollar, as are stocks today, but we'll see how long that holds for. Currently, the 2-year at 4.98, again, after crossing above 5% yesterday. 124 on the pound as we look at the inflation data out of the UK, 7 a.m. UK time, expected to come in at 3.1%. That's the estimates. $89 a barrel on Brent, currently down 0.5%. Still a bit of wait and see when it comes to Israel's reaction and response, of course, to those attacks from Iran. And iron ore, as I say, prices jumping in the session today. We watched the miners then at the open in the UK, up 3% currently on iron ore at 112 per tonne. Let's return to the morning's top earnings story then. It comes through from ASML. The new orders falling short of analysts' expectations, higher by slowing demand then from the chip-making industry for its most advanced machines. For the details, let's bring in Bloomberg's EMEA Markets editor David Watkins, standing by for us in Amsterdam. David, at first glance then, the numbers look disappointing. Is that a fair assessment?
Yeah, there's definitely, the numbers there that can be seen as disappointing. It's a bit of a mixed bag. It's kind of a story of a continued downturn in demand when it comes to the semiconductor industry. And I think investors in ASML will have known that they'd have to stomach some volatility this year as the chip industry grapples with, the lingering impact of inflation and that kind of thing. So yeah, there's obviously numbers here which do look disappointing. There's also other aspects that could be taken positively. Their outlook for the full year is unchanged, and the company has also said that they expect a stronger second half.
What is the China? Where's the China story in this, David? And are there other obvious reasons for the softness?
Well, I think for ASML, one of its challenges has been demand delay. It's always said that this year would maybe not be so spectacular when it comes to the numbers because it's this is the company it's the only company that makes these machines which can build the most advanced semiconductor chips for AI processes, and so it has to wait really for more fabrication plants to be made around the world. So it's always pointed to next year as being a year in which investors should really be ready for. With China, the restrictions these fully kicked in on January 1st. Those restrict ASML from selling less advanced machines. So when it comes to the EUV machines, which are what many investors will be looking at today, it's not able to sell those anyway. So it did say earlier that it expected China sales to fall something like 15% this year based on the early restrictions.
OK, so we continue to look ahead to 2025 as being potentially a really strong year for ASML, as you say, a year that they flagged. When it comes to those EUVs then, the extreme ultraviolet machines that they ship out, sometimes in 3 Boeing aircraft, given the size of them, decent demand, it seems, for those very high-end pieces of kit. Does that look like it's going to be sustained? Where is that demand coming from?
Well, this is the thing. I mean, looking through the numbers, EUV orders in the previous quarter were something like 5.6 billion, and this quarter they actually fell quite considerably. So I think again, it's there's a number of factors in terms of what ASML is facing. Obviously, artificial intelligence is going to be driving demand. It's going to be a major driver of its business and the business of its customers over the next few years. It's just dealing with a fairly sort of lumpy timing in terms of orders at the moment. And again, there will be high demand for this. This is pretty much the only game in town when it comes to these machines. So, they always said expect a fairly sort of fluctuating few months in 2024 before things really start to accelerate in 2025.
OK, David Wilkins out of Amsterdam on those ASML earnings. Thank you very much indeed. Meanwhile, staying in the tech space, the CEO of IT firm Atos, which has been struggling with tumbling shares and a wall of debt, says he's confident the French company will be saved. Paul Salas spoke in an exclusive interview with Bloomberg's Caroline Connor in Paris.
Actually, working with our creditors, both our banks and our bondholders, for a solution to our high level of debt, and the maturities are coming due in the next 18 months. And the dialogue is very, very positive. It's we're operating under the conciliation, as you have mentioned. It's like a mediator is helping through those discussions. And I do believe that everybody is aligned. In fact, we recently had secured some liquidity from those same bondholders and banks. Again, an indication that everybody is really aligned to find a solution.
So what else could be part of the proposal apart from this group of bondholders? Are we going to see, for example, some asset disposal announced before the end of next week? Is that a possibility, or do you totally exclude this?
I think what we have presented is a comprehensive plan that included all the assets of Atos. Now we're going to have to see what proposals are going to come through. Some of them will just keep the whole of the company together. One of those proposals is likely to come from one of our largest shareholders. And others will come in from our bondholders who seem to also be interested in keeping the whole company. But we can't just really forego any potential proposal that may come in and may entail a different mix of ideas, such as asset disposal or not.
Will this whole plan be able to save Atos?
Actually, Atos is a great company, as I mentioned to you. It just really is going to be, I do believe that we'll come up with a plan and the company will succeed long term.
So it will be saved?
It will be saved.
OK, Paul Salas, the CEO of Atos, speaking exclusively with Bloomberg's Caroline Connor in Paris. Now, JPMorgan is all in on AI. In the premiere episode of The Circuit's second season, the CEO, of course, of JPMorgan, Jamie Dimon, speaks with Bloomberg Originals host Emily Chang about the opportunities and risks for the technology.
Be prepared for any business. When you think about risk, think about things that can go terribly wrong. Can you survive them? It could be technology, it could be government regulations, it could be literally the weather. If you're a restaurant, that might close you down. If you lose this week's business, you're out of business, you don't have enough cash. So you should think all that through.
Bill Gates once said, banking is necessary, banks are not. To what extent could AI or fintech replace traditional banks?
So I think, first of all, I remember him saying banks are dinosaurs. I spoke to him about it in 1997, and he was dead wrong. He'd probably agree to that. But he's not wrong that technology changes everything. And if anyone is complacent or arrogant or think that because you have a big position today, you're going to have a big position tomorrow, that's a mistake. But then you have to define what is banking. Someone's going to have to hold the money. Someone's going to have to move the money. Someone's going to have to raise the money. Someone's going to have to do research around money. Those services will still be around. And, hopefully we're doing it and using a lot of tech to do a better job at it. But I've always thought it's very possible that some tech thing, disintermediates a piece of that. And I've been writing about, big tech going to our business. We got fintech, but we also have big tech. And they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
Well, we're going to compete. So they have a tough competitor, but they hold money, move money. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people.
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
OK, JPMorgan CEO, of course, Jamie Dimon. And you can watch The Circuit with Emily Chang tonight, 11 p.m. UK time on Bloomberg Television. And you can stream it 2 hours later on Bloomberg Originals. Now, for some of the other stories making the news today in the banking space still, HSBC said to have started a new round of job cuts at its Asia investment bank. Sources say the lender laid off around a dozen bankers on Tuesday. It comes as deal-making across Asia has slowed, of course, especially in Hong Kong and China. Other banks, including UBS and Goldman Sachs, have made rounds of job cuts in Asia over the past 18 months. Emirates is halting all check-ins for passengers for the day as bad weather in Dubai disrupts travel in one of the busiest aviation hubs in the world. Dubai has seen, yes, torrential rains and heavy flooding, prompting flight cancellations, school closures and traffic disruptions. It stemmed partly from cloud seeding operations that are meant to encourage rainfall in the UAE. Coming up, the UK's Chancellor tells Bloomberg the start of rate cuts could lift the mood in the UK and hints at an autumn election. We bring you more with our interview with Jeremy Hunt next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the UK Chancellor Jeremy Hunt says the prospect of interest rate cuts later this year would lift the mood of voters, hinting that the government won't call a general election until the autumn.
It's a decision for the Independent Bank of England, just like here in the US. That decision is taken independently. And they have to look at lots of things. I mean, we've still got very strong wage growth data. It's been going up for 9 months in a row in real terms. But I think the big message from today is that the IMF are saying that inflation is going to be 1.2% lower. There are people who are now forecasting inflation will be lower in the UK than in the US or possibly even the Eurozone. And so, you know, that situation we were in 18 months ago with inflation at 11.1%, that is well and truly behind us. And if you're looking forward in terms of longer-term growth prospects, the IMF today are saying that the UK will grow faster than France, Germany or Italy over the next 6 years. So we think we have very strong growth prospects.
So you aren't concerned at all about what potentially could happen to parts of the UK economy, like the labour market, if policy were to stay too tight for too much longer, given what you are saying is a downward trajectory in inflation?
Well, obviously, in the short term, we look to the Bank of England to get that fine judgment right. But what finance ministers like me can do is much more about the longer-term competitiveness of the UK economy. And we note that the IMF today say there's a whole section about the impact of AI on the UK economy because they recognise that London is now the world's second largest epicenter for AI R&D after San Francisco. And there's a huge amount happening in our tech economy, which is third only to the US and China globally. And that is really where the big growth in the future is going to come in the UK, and that's where we think makes it a very exciting bet for investors.
Well, and your point is taken, Chancellor, that you oversee the fiscal side, not the monetary side. So on the fiscal side, you have suggested that an election could happen potentially as soon as October. Should we expect another potential fiscal event between now and then, or have we seen all we're going to see on that front before the votes are cast?
Well, it's certainly the case that, the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn than it is now. People have been through a very bruising period. Obviously, decisions about election timing are for the Prime Minister, and were we to have an October election, as I've said before, it would be possible to have a fiscal event in September. But we would decide much nearer the time whether that was the right thing to do.
Well, of course, you've already delivered a lot fiscally in terms of tax cuts, including personal tax cuts. And yet, when you look at polls, obviously the Conservative Party is still running significantly behind Labour, I believe by roughly 20 points. What else may need to be done on that front to convince UK voters to keep the Conservatives in power? What would you consider doing?
Well, I'd be very cautious about looking at those polls because, first of all, as we can see from the challenges facing incumbent governments, not just in the UK, but in the US and Germany, France, the electorate have been through a really difficult period with an energy shock, with high inflation, with a pandemic. But when it comes to a general election, it's a choice about the future. It's not a referendum on how you feel right now. And that becomes a very different decision in people's minds.
OK, UK Chancellor, of course, of the Exchequer, Jeremy Hunt. Let's get more then from Bloomberg's UK correspondent Lizzie Bird in terms of the take on what we've been hearing from the UK Chancellor. What stood out to you then, Lizzie?
Well, it was nice of him to drop in while he's in town for the IMF meeting, wasn't it? The main point that I took away was that he says rate cuts later this year will lift voters' moods. So that confirms essentially our expectation, Rishi Sunak's working assumption that we're not going to have a general election until the autumn. But it's more interesting, I think, in the context of what we've heard from the Governor Andrew Bailey, saying that the UK could cut interest rates before the US. Does that mean that the general election could come sooner in the UK as well? He mentioned the IMF forecast. They were expecting that UK inflation is going to average 2.5% this year, so lower than the US, in line with other European countries. The flip side of that, though, is weak growth, lower than any other G7 nation bar Germany. And, of course, Tom, that's going to be a concern as well as Rishi Sunak heads towards this general election.
And, of course, we have that. You touched on inflation. We have the inflation dropping 7 a.m. UK time, of course. And really interesting, given what you said about Bailey yesterday, really drawing a line in terms of, in the sand between the inflation dynamics in here in the UK versus the US. And that's a change that we've seen in the last 6 months or so. That was really interesting yesterday. Talk to us about what to expect from inflation then.
So economists expect a drop from 3.4% to 3.1%. So underscoring that divergence between the UK and the US inflation pictures, even if services stay sticky in this data, it's looking like the UK is finding it easier to get towards the 2% target. Now, you did see traders paring their bets on BOE cuts after that hot hat trick of US CPI prints. It's interesting because the inference from that is that the Bank of England waits for the Fed to cut rates. Our economists don't think that that's the case. They think that actually the Bank of England could cut in June and by more than the market expects. Of course, it's going to depend on the likes of Catherine Mann and Jonathan Haskell, Megan Green, who are still concerned about inflationary pressures here in the UK. But just take a listen to the Governor Andrew Bailey, because he seems to side with our economists on the idea that the Bank of England has got a mind of its own.
Dynamics of inflation are rather different between Europe, and I mean Europe geographically now, and the US. I think there's more demand-led inflation, probably pressure, and a bit more in demand-led inflation pressure in the US than we're seeing. So I think the inflation dynamics are different. We're still seeing the extension of the process of coming out of the big supply shocks that we had, the impact of the war, the impact of coming out of COVID.
So the Governor referring to that demand-led inflation that's present in the US compared to the UK. Markets currently see a first rate cut from the BOE in September. If we get a softer CPI print this morning, could it bring that forward to June? OK, the countdown a little under 10 minutes away from that inflation data. Lizzie Burden's going to be across all of that with the analysis. Of course, Lizzie Burden, our UK correspondent, thank you very much indeed. And stay tuned for our interview with former UK Chancellor Philip Hammond. That's going to be interesting as well. 9:10 a.m. London time on The Pulse with Francine Lacqua. Plenty more coming up on Bloomberg. We're going to get a deep dive in terms of the halving of Bitcoin and reflect again on the pricing around the Fed. Stay with us. This is Bloomberg.
The Olympics, Sporting World Cups, leap years, and Bitcoin halving. They each happen every 4 years, and in the crypto world, halvings typically meant a boon for prices. In a nutshell, Bitcoin halving means fewer new tokens are issued. That's because Bitcoin miners, who validate blockchain transactions, receive 50% less of a reward for doing so. At Bitcoin's launch in 2009, miners received 50 new coins per block. Post the halving in 2024, that'll be cut to just 3.125 Bitcoin instead. In the past, we've seen prices spike following the event. For example, in 2012, when the token jumped by 8,000% in the following 12 months. This time around, the prospect for further gains is unclear. Some analysts say the halving could trigger upside of at least 80%. Others argue the event is already baked in, particularly as Bitcoin's already risen to fresh records this year, which brings to mind a familiar phrase, Past performance does not guarantee future results.
Okay, as Annabelle was saying, the question around how much is priced in around Bitcoin is key, of course, as we lead up to that halving event, likely around April the 20th. You've seen about 50% gains for Bitcoin year to date, and you got that record 73,000 around the March level. You see that charted out here, but just to reflect on the 50-day moving average, which is around 67,000, you're comfortably below that right now. The last time I checked, we're at around 63, 64,000 for Bitcoin. So does that provide an opening for further upside? Or are we now capped at these kind of levels? Again, the key catalyst that came through for Bitcoin this year, expectations of rate cuts, but also those inflows into ETFs and the halving event. And on the rate cut question, let's flip the board and have a look, because, of course, the markets have been repricing all of that. We had the comments out of Jay Powell yesterday. Again, a marked change of tone from the Fed chair. Just reflect on where we were at the beginning of this year, when expectations were that you could get as many as 6 rate cuts. Now, the expectation is that you're not going to get a first full cut until potentially September of this year. This is the effective real rate, the effective funds rate from the Federal Reserve, around 5.3%. And the purple line is the expectation, the swaps rate around September, where you get to around the 4% level. So that's the expectation changing, that you may get as few as 1, possibly 2 cuts versus the 6 at the beginning of this year, the way that markets have repriced this view, and the comments from Jay Powell tying into that has implications, of course, across asset classes, but including Bitcoin. Let's check in on these futures then. It's an earnings day. ASML with a disappointment. LVMH, the ADR's actually ticked up despite sales slowing again for that luxury group to levels we haven't seen since about 2016, if you strip out the pandemic. So we're looking at luxury, looking at the miners as well, given the tick up in iron ore prices, and again, looking at the semiconductor space on the disappointing order numbers coming out of ASML. Futures now in Europe, having started off the session in the green, now flat. FTSE 100 futures, though, looking to gains of 0.2%. I wonder to what extent the miners are playing into that story. The DAX futures, meanwhile, looking to add around 21 points, up 0.1%. Up next, of course, markets today, where the team will be deep diving in all of these questions around central banks, around the earnings story, and crucially for the UK, the inflation data that drops in around 3 minutes' time. That is Markets Today next. This is Bloomberg.